All right. Welcome everybody to our weekly webinar here at BEEC. We're very excited to have a special guest here. A special guest for many reasons. He is a seasoned Wall Street finance professional, Brian Weisman, but beyond that, he's also my oldest friend. So it's really quite exciting to have him on for our BEEC weekly webinar. So Brian, welcome this week.
Thanks for having me here, John.
Absolutely. And we thank everybody else for taking the time. We see that number climbing up as people are funneling in. We always appreciate everybody taking the time to learn on a Friday evening, or for those of us abroad on a Saturday morning. We do think this topic will be really interesting for our students, parents, about what it really means to be working in finance and what's really going on in a lot of different investment areas from someone who does it professionally. As far as everybody in attendance, of course, I think some of you we recognize from the names, but some of you are definitely new to BEC. So at BEC, what do we try to achieve? We always say, yes, it's true. We do your typical college consulting. We help students to apply to schools. We do tutoring. We do test prep. We help students, in those aspects. But what we think differentiates ourselves from other companies that do similar type work is that we always are very career-centric, as in, what is a student really trying to achieve by working so hard in school? What are they trying to achieve in pursuing a certain major in college? College is supposed to be a stage of development for your future. So if we can help students to better understand that future goal, then suddenly the high school plans can be a lot more impactful. Then suddenly what you do can be a lot more purposeful. And then you become a better applicant for college too, because colleges wish you to be that type of student with a strong vision for yourself, with strong background and activities. So we try to provide the proper support for students in that way. And that's why we're always really are happy to have, great speakers like Brian, who can really, help out, younger people into hopefully having a better idea for their own futures. And that's why we're also really proud to have our special internship opportunities with partner companies and special research opportunities with partner professors. So in that way, students can be supported totally. And of course, if anyone wants to continue the conversation, we're always available. You can call us, you can email us, you can sign up for a free consultation. We have our WeChat, and maybe there will be no WeChat in a couple of days, but we think there still is WeChat. Either way, we're always available, and all I want to do is speak to more students, more parents, and try to be part of your child's educational journey. So I'm going to hand it back to Brian. Before I do, gotta do him justice. We started at Barclays doing investment banking out of NYU Stern, and has just kept ascending ever since into hedge funds analyst, into a vice president position, and now very exciting, starting his own fund at what one can say is quite a young age, but really always been very impressed with his success. And I'm excited to learn this evening. So I'm gonna let him begin before I say too much. And yeah, I'm gonna pass the microphone now. You can be that.
You always flatter too much, but hope everybody's having a great evening or a great morning. Thanks for having me here again. I'm very happy to be here. So I was told the theme of tonight's series would be a Back to the Future, how to prepare for a changing world. This is going to be a Wall Street themed discussion, but I thought about that theme, and to be honest, the world is not going to change that much. On Wall Street, you'll see that recessions typically accelerate what was already happening before, but nothing ever happens overnight. This pandemic has certainly changed the world, but unlikely to the extremes that some would like you to believe. I think you should always ask yourself, and this is actually a key part of being on Wall Street, if it's something that's intriguing to you, why are they trying to get me to believe such extremes to begin with? Oftentimes in school, in essays or public speaking classes, your teachers will have you ask yourself, who is my target audience? But on the contrary, very few times are you actually asked, who is the speaker or writer, and why is he or she giving me this information? On Wall Street, I think that's a pretty good skill to have, and probably one of the most important ones. So I was thinking about this series tonight, and in a recent headline, I saw the following announcement. I'm not going to name which bank made this claim or which publication because, we're just going to make sure it's anonymous. But, the headline went as such: no longer seeing a recession, fund managers are beginning to shift into industrials and value stocks, says Wall Street Bank. That was the headline. And it's, one of the top Wall Street banks in the United States that, you would have heard of if I had mentioned the name. As big events happen to the world, to the economy, to the stock market, you'll always see any spokesperson or analyst or publication try to build a following with bold statements that aren't always supported by data. If you click the link into this article, if I gave it to you, you'd see a bunch of survey data that showed, yes, you are seeing fund managers shift into industrials and value stocks. But let's really think about this. First off, it makes for a very catchy read and increases the engagement with the potential audience when you make bold claims. If anybody who takes marketing would know that, right? The bank, at the end of the day, wants to increase its prominence as an analytical institution and attract additional engagement with its customer base. So doing that type of headline is beneficial to them. But let's examine the actual statement and break it down. Well, why would managers actually go into value stocks? There could be a lot of different reasons. But right here, they're saying it's because they're no longer seeing a recession. If you actually click into the article, there's nothing that shows that because of managers not seeing a recession, that they're actually making this shift. So how is the structure actually broken down? Well, the very basic logic class structure that you'll take in college is if A, then B. And typically A is some sort of premise and B is some sort of conclusion. But what if A isn't actually true? Then, at least from an investing standpoint, you would have just invested based on a false premise and probably increased your chance of failing tremendously. So the premise here is no longer seeing a recession. And as a result, they've made these decisions. But there could be a lot of different reasons why people are shifting into industrials and value stocks. And I'm happy to talk about that in questions later on. Let's take another premise or conclusion. So I'm not going to give a specific name. I have a company in mind, but XYZ credit book spreads are growing, and credit book spreads are basically the rate at which you lend versus the rate at which you borrow. And there's a spread that you capture when you're in a financial institution and you make some money. That's how a bank works. So this is some institution that lends and borrows and makes a spread. So XYZ credit book spreads are growing, which is due to excellent underwriting and a high quality customer base. Okay, so we know the credit spreads are growing, which typically is a good sign. But is this sustainable? What if I told you that the customer's primary customer base is low credit score customers, and that they sell cars online on an online only platform at a 30% markup to its competitors, and they still can't turn a profit? Do you think this is still representative of a great business, which is implied by the statement? So, another premise and conclusion that's interesting. Let's take another one. XYZ's healthy balance sheet is due to its working capital optimization in the recent financial quarter. Okay. Let's say this company actually received lots of price target upgrades by Wall Street analysts due to this move in liquidity by the working capital optimization and perceived credit quality enhancements. But what if the reason behind the working capital changes was that the company was close to bankruptcy and it was liquidating its inventory to keep it afloat and kick the can down the road. Should you be upgrading the stock in a way that spins the story somehow else? Probably not. So those are some things that, you know, I like to examine on a daily basis. Is I'm presented with a series of premises and conclusions that are derived, and I'm thrown a lot of these every single day of my life. And I have to filter out all the noise and figure out, you know, what is true and what is not, and look for things that are concrete and at least highly probable. You can never really get extreme certainty in Wall Street. It usually comes at the final hour, but over time, you can have rising probabilities of an outcome. Usually there's a series of outcomes. So, you know, there's a lot of things that I've learned, and I kind of thought about some kind of major life lessons that I could impart that, you know, I think really talk to, you know, a career on Wall Street, if that's something that's appealing to anybody here on the call. You know, I'd say the number one thing is the most common misconception, at least about hedge funds, is that you have to be some sort of math whiz to succeed. You know, contrary to popular belief, math was always my least favorite subject in school. I do build predictive models in Excel, and it's a key, crucial part of my investment analysis. But I find that the more important skill is to read in between the lines. Your ability to synthesize, interpret, and weed through swaths of information and come up with a unique assumption and premise to model into your quantitative analysis is going to be the needle mover that impacts decisions on a day-to-day basis. Without your ability to do that, you cannot have a career on Wall Street, at least not one in hedge funds. There are other careers on Wall Street probably where that is not as valued, and it's more about just how hard you can work. But I think if you want to be able to do a hedge fund career, I think that will be one of the most critical things that you can do. So always question the premise. 100%. That's a huge part of the job. There's also a huge part of the job is now risk management, especially over the last 10 to 20 years, as you've gone through, you know, the dot-com bubble and bust, and the credit crisis, housing bubble and bust, and now what seems to be a combination of 4 different recessions all in one. Risk management is really important. So I always think about, there's 2 things in statistics that you'll learn if you haven't already, but there's type 1 and type 2 error. And I really always like to think about both. So type 1 error is basically rejecting a true hypothesis. So getting out of a winner too early, or missing out on additional profit from a thesis that is actually true. Oftentimes people do this because they doubt or fear about their thesis being untrue, and fear that it can become wrong. So another way of saying this is you should play to your strengths. And the key to success, at least from an investing standpoint, is knowing when to, stay the course with something that's a winner. On a type 2 error, is kind of the opposite angle. So we're talking about accepting a false hypothesis. So staying in a loser too long, or usually believing in a false thesis. Another way of kind of saying a lesson from this is really try to avoid, your weaknesses. That's more of a generalized answer there. But these are 2 really key components of risk management that you'll kind of evaluate in your career as you go through and do, different things. It's very important. At a high level, I'd say being able to see the big picture of how the fundamentals and the different risk factors impact each other. You know, when the world is presented to you, are you able to see, you know, X, Y, Z, and how the landscape all flows through with one another? Because really, that's where the magic happens, and how you can go from being, you know, an analyst or an entry level guy to somebody who's starting their own fund. I think you have to be able to see that. So that's things like, you know, what is the Federal Reserve doing and the other central banks, and shifts within a sector or an industry, technological disruption, monopolist power influence, stuff like Amazon and all the big tech companies, currencies, commodities, and rates, unit economics. Am I running an oil business and suddenly I'm totally not profitable? You know, and the product and service portfolios, strengths and weaknesses. There's a lot of things there, but those are kind of different aspects that I think are very crucial to a career as well. And something that, you know, probably doesn't get enough attention is the actual you know, career path. So, you know, a lot of you are going to go out there and go out into the real world after college, and, you know, you're trying to figure out, you know, I had this like A to Z plan of I'm going to do this job for a couple of years, and then I'm going to go here, and then I'm going to do this. And, you know, I could give you that path for hedge funds, and, you know, but in reality, you know, you're going to put all this pressure on yourself for that ideal career path, but imagining as if there's some sort of straight line from point A to point B. And to the majority of you, though, you're going to face a much less direct path. And just because the job doesn't work out, you know, doesn't mean that it's your fault. So I've worked at, you know, a major Wall Street bank and several hedge funds. And, you know, I've learned a lot more from my mistakes than my success. You know, the best advice that I can give, because a career on Wall Street is not for the faint of heart at all, is to calmly reflect on your experiences as they happen and determine where you were weak or could be better, and isolate it from the feedback you receive. Because as I said before, you know, it is common actually for employers to place all the blame on the individual when a job doesn't work out. So as I said before, always ask yourself, who is giving me or telling me this information? And, you know, this kind of goes into my next point here. And this can apply to, you know, non-Wall Street jobs, but also on Wall Street. I think a career on Wall Street can be tough because there's so many different factors that go into whether you're going to be successful in a job. Okay. You have to consider the industry. Okay. Is there competition? Is it growing? Is it declining? Are people pulling money out? Are they putting money in? Hedge funds as a whole on this factor is pretty tough. You know, you have this massive switch from active to passive that's been happening over many years, and active managers have underperformed the market consistently in the last decade. And not since the 1990s has it been really good in this area. On a net basis, funds have been leaving hedge funds. So what you're really seeing is, you know, the top performers are gaining new assets and building larger hedge funds, and the majority of the industry is shrinking. But this is not true for all industries. There's other industries where you can be in an investing role and everybody's getting new money all the time, nonstop, as if it's just being thrown at them. So you really have to think about it. Another aspect of this could be the cultural risk, right? So you don't know necessarily when you go in or not, but try to gauge a sense whether the job is more formal or informal, fast or slow, bureaucratic or flat. It can be really key to tie your kind of cultural affinity to working to where you're going to work. Because if you prefer a certain type of environment, you're really only going to excel in that environment. And I've really worked in every type of, you know, cultural environment on Wall Street, and they can be very different. You know, one of the funds I worked at, you had to do mountains of paperwork, and it took months to make an investment happen. And another fund I've worked at, you could do everything in a week. And in my fund, I could do everything in a day. So, it really changes. Another factor here is business model risk, right? So, the company that you're working at could have its own, challenges and goals that are totally agnostic from your career. So finance, everybody likes to try to make as much money as possible. And that's all they think about when they think about finance, including your bosses. So they always take risks that aren't necessarily in the best interest of your career. So thinking about the type of firm that you're going to work for, if they're taking those risks, you really want to try to steer away. And sometimes you can tell before you join, sometimes you can't. But oftentimes if a firm is putting extremely aggressive goals on growth ahead of the firm, it can be very difficult for that firm to reach those goals. And oftentimes when they, let's say, do a massive hiring wave, unless they have an amazing year the following year, usually that results in a massive firing wave. So that's something to really consider, that you're not going into the wrong type of place. Also, there's a supervisor risk. So I'd say, whether somebody's a micromanager versus hands-off. If you're in Wall Street overall, they don't usually like to hear your opinions. But in hedge funds, it's a very important part of the job. And, you want to know whether your supervisor is somebody who can entertain ideas that are not his own, his or her own, because it's not consistent across Wall Street where that's the case. So you have to be nimble in this area and really try to be, flexible, but realize that every job is different. It's truly its own beast. Your strengths and weaknesses, extremely important, versus the job function, which can change and evolve over time. So, I think making sure that you learn what those strengths and weaknesses are can really serve you well, but you're not going to know all of them right before you get into a job. So sometimes it takes getting into a job to actually learn, like, hey, I'm not really good at ABC. I should do XYZ, and therefore this is not the job for me. That rhymes unintentionally, but then you go do another job after that goes much better. So that's really important. Just in the way that you analyze businesses for investments, you need to be analyzing yourself very critically without avail. And also, make sure you go somewhere that really is interested in investing in you for long-term growth and is an efficient use of your time so you can focus on the high-impact tasks versus low-impact tasks. Every time you start a new job in any industry, entry level, there's always going to be a lot of grunt work. It's going to be a lot of what I would call low-impact tasks, and you're going to know what they are when you're doing them, and that is not even worth talking about them right now. But, beyond the first couple of years, you really should see that evolve. Even the first year after that should evolve very quickly. And if somebody's not investing in you to go beyond that and doesn't really care about your time, you need to evaluate that, because there's a lot of people on Wall Street where it's just a part of the culture. They would rather have you make them a lot of money and you spend 10 years not learning anything. I've seen it happen to a lot of my friends. And you just have to really fight for everything that you can for yourself. So it's a tough career. It can be really rewarding, but you really have to be extremely diligent on fighting for the growth that you want to see in your career. No one's going to give it to you. I'd say, key again to doing well on Wall Street is, figure out what type of firm matches these answers to the questions I discussed kind of above, and go work for them. It's going to be a journey, but have some faith, never give up, and you'll get there. It's possible. And I think all of you are extremely smart. I'm sure there's lots of opportunities ahead. So definitely will be available to you. If you guys like the way that I think about the world or find what I've said interesting, then it's possible a hedge fund career might be the right long-term fit for you. Maybe something else on Wall Street. But again, thank you all for tuning in. I'd love to open up the line for questions if
Sure.
you're there, John.
Well, thank you very much, Brian. I think it was pretty illuminating. I think, anyway, you're speaking from true experience, really trying to communicate some really important pieces of wisdom that probably don't get mentioned in your typical finance class or anything like
No,
that,
definitely
right?
not. Yeah.
And please, if anybody in the audience does have questions, please do write them into the chat or in the Q&A. I know I have a couple of questions just from listening. And okay, all right. Well, I'm going to attend to okay. Here's a fun one. Which IB banks, which investment banks are the best?
Are the best?
Yeah, you tell us which ones are the best.
Uh, I mean, I'll be honest. If you get a job at IB Bank, you should be very proud of yourself. All of them are great. Uh, any of the well-known ones, I think, will create opportunities for you.
Sure.
If you want to know 100% what I think are the best, I would say, there's probably like 5 or 6 banks that are the top banks.
Mm-hmm.
Goldman Sachs is usually considered one of the top ones. And I'm sure that's not a surprise.
Okay. Wait, I guess Goldman Sachs is. Who can argue with that?
Yeah, I mean, if you look up like,
right,
top 10 largest banks in the United States, if that's where you're interested in working, then, they probably are all going to create opportunities for you.
Right. Having experience at those banks will set you up for your career well. Okay, great. We do have a couple more questions coming in. Can you describe a little bit what are like the front desk, middle desk, back end jobs?
Sure.
These terms get thrown around. What do they mean?
So, middle and back is always a little bit like, I think they overlap a lot more than people really believe, but at least within a bank, the front end job in an investment bank is, the guy who's working on the deal team, as an investment banker, right? So that's somebody who's generating fees for the bank to do these big deals, whether it's a leveraged buyout or a big merger and acquisition of XYZ company or an IPO. You get a fee as the bank for structuring and advising on those situations. The bigger, the better. That's how it works. And so I'd say that's a front end. Middle office, you would say, I don't know if you're familiar with, but there's equity research or credit research. So this is something where it's not paid for directly due to regulations, but they produce kind of a product that's important for clients. It's a really rewarding job. You're not investing, but you're putting out research for the public to consume, typically institutional investors, because it's expensive to get access. But you don't pay for it directly. There isn't like a subscription that you pay the bank to get access to Goldman Sachs research. You actually pay for it by trading with Goldman Sachs. So commissions that Goldman Sachs makes on hedge funds from trading with them or other institutions will go to pay toward research as well. But back office can pretty much be anything else. Another thing in middle office might be like, compliance or strategic development, business development for a bank. But back office would probably be more like IT, administrative, accounting kind of thing. So that's how I think about it in a bank. In a hedge fund, there's no such thing.
Got it. And okay, we do have a few more. These are all quite good. What is the buy side? What is the sell side?
That's a great question. So, buy side is anybody that basically actually deploys capital. A sell side is somebody that is actually, that's an easier way to explain this. Buy side is basically somebody who is holding inventory, and sell side is in the business of moving inventory. So in the buy side, you have firms of institutions that are making investments or they're basically investing capital, whether it's their own or others. That's the buy side. Sell side is, an institution who is basically oftentimes moving risk off the balance sheet. So sometimes a bank helps support a deal by putting their money in, but they immediately de-risk and move that investment off to other investors. They repackage it, sell it off to other investors who want to hold that risk. Mm-hmm. So a bank is typically only about fees and about advising and making fees from selling their services.
Right.
And that's the way to think about it.
So you just for the audience, so you would say like the buy side, for example, like a hedge fund is that
sure.
So
yeah, so examples would be like hedge funds buy side, I don't know, like any type of mutual fund or fixed income, that's all buy side. Commodities, if you invest in commodities like oil, that's buy side. Mm-hmm. Sell side is usually a bank. Sell side is pretty much, I think, a bank is the only thing that really fits into sell side.
I understand. They're really selling services, advisory services to complete transactions. Yeah. Okay, I think that makes sense. Here's a good one. And maybe you have direct experience to answer this. Is a bachelor's degree enough to do a good job?
That's a good question. I would say yes. I got a bachelor's degree from a great institution. I did a lot of training and work on my own outside of school. So I would say, to answer this question, it really depends on the individual. If you're somebody that is hungry to learn and really dive into finance and kind of embody the spirit of Wall Street, then I think you can make it in the career. But it's a lot of kind of your own time that you have to invest on top of the curriculum in a bachelor. I did an undergraduate business program, and I majored in finance. You're going to have to do a lot more than that, but you don't have to get an MBA. It can help for certain jobs that care about that, but it depends what your goals are.
Sure. Okay. I think that makes sense. We have a few questions. Some of them are tied together. I'm going to try to synthesize them. But basically, here's the first one. Is risk something that is going to be replaced by AI or how is AI impacting the field in general?
Yeah, that's a great question. So I would say that this is happening, for a long time, this evolution of kind of, proliferation of computers into risk management. And a lot of times individuals are the ones designing the algorithms. 99% of the time, that's what it is. We're still not at the level where computers are really, self-thinking to the point where they're coming up with, the big picture. There are some machine learning algorithms in trading, but it doesn't really work on a kind of a long-term level. It works really well for short-term announcements. So let's say, the Fed announces something that's negative or can be taken negative, probably, the computer can figure out maybe what to do by a couple of keywords that, in the past have led to declines in the stock market based on the Fed, right? So that's something that you can teach a computer, statistically speaking, when the Fed does this, what do you do? And so they can do that on a single day basis. But they don't really understand the ins and outs of, what is this company worth based on a bunch of financial statements. And, I think, that's important to know going into a really tumultuous environment like we're in. A lot of people think we're getting out of a recession or we're not really in a recession, and like, what are we in right now? Who knows? If you watch the markets for the last 2 weeks, you think we're about to go off a cliff, but I actually would argue the opposite. So, it's an interesting environment, but, I guess the short answer is, there's an evolution of AI into risk management, but at the end of the day, it comes down to the individual, the portfolio manager at the fund making the decisions of what the risk factors and risk exposure is for different investments.
That makes sense. We have a couple questions I guess I can combine. Is A, if someone wants to get into security trading, do they need a degree? What should they study? And then 2, is there a typical personality or better fit personally for finance and IB and trading and these things?
Yeah, so that's a great question. I would say classes that are important if you can, and you don't necessarily have to, but if you can do corporate finance, if you can, if you have time to do a CFA, it's nice. It's usually in lieu of somebody who didn't have a finance background. I think it would help even more. I like to do it because I love finance, and for me it was even more of a passion. There was definitely some things that I learned along the way that I didn't really think about. I would say corporate finance, any type of valuation class, accounting is important. Macro and microeconomics also extremely important. Statistics is an important class. And you really practicing and understanding, like, how do I build a model to understand, what is this company worth? Like, that is one of the most fundamental things that I do and I've done for the last 10 years. And I think, you really have to be able to do that. If you're not doing that, it's not gonna really help you in the career.
Do you find specific majors to be most helpful, or it can really be a mix? Depends on kind of a background.
I think it can be a mix. I think at the end of the day, it's about whether you're hungry to kind of develop the right skills and that you actually care about the markets. Like, if you're somebody who's gonna, you major in English, or you major in math or whatever, or you major in, you name it, but you read, Wall Street Journal every day, Financial Times, and you keep to date on the markets, and you're watching, CNBC or Bloomberg or whatever every single day or every week, and you really have a passion for it, then it's a good career path for you. But if you're not doing those things, it's just not for you, and it's going to show whether you're interviewing for the job or whether you're on the job that you don't really care about it.
I understand. Yeah, and it's really that follow up, or what's going to keep driving you, regardless of the specific skill set. Because like you said, you'll be learning on the job, and then there's so much stuff maybe you can't prepare for. This is a good question. How much computer science knowledge do you need?
Yeah, that's a great question. I'd say it's extremely relevant if you're going for a quant trading role. So there are opportunities within quantitative trading where computer science is required. Yeah. So there they'd say get a computer science major. Sometimes they want PhDs, but basically your whole job is programming software and algorithms to trade the market. So this kind of ties into the AI question earlier, which there's this rise of some quant firms where there are no individual financial analysts and kind of investigating the value of a company. They're just making a bunch of programs for the computer to trade the market based on kind of short-term decisions, like I mentioned earlier with the Fed. So those are things that that's another opportunity path. It's a little bit different. It's not one that was my path, but definitely is another opportunity if that's what you're looking for.
Okay, that makes sense. Here's a fun one. What do you think about Robinhood? Is it making everybody crazy, or what's your take?
Robinhood? Yeah. I think it gets a lot of attention and it makes for really catchy headlines. There's some correlation between Robinhood traders and the activity in certain types of stocks, but they're not moving the market in the way that people would like you to believe.
And maybe the headlines are so exciting and fun that they get written, even though perhaps the evidence is not there that they're really so influential.
Yeah, there's evidence that there's a rise in Robinhood activity, but it's not. It just doesn't move the market like
you're not having the effect that
We're
it
not going to
feels.
be watching a movie that's like The Big Short in like 5 years where they talk about the Robin Hood traders who moved the
No,
market and therefore caused the big crash of
sure.
2021 or whatever. So I don't want to even put that out there.
Understand. Oh, those were the questions from our audience, which were really great. And I had a couple of questions just from your talk, and I think these are things that,
Sure.
regardless of industry, I think some of them are true. You were saying that throughout your career, you've learned a lot more, perhaps from the mistakes, or from things that didn't go so well, than from the times where things went well. I want to know if you wouldn't mind divulging one mistake. It doesn't need to be your biggest, whatever you're comfortable saying, but is there a mistake where you felt that it really did help you to learn?
Yeah, I think it's a really good question. One of my first investment on Wall Street for a hedge fund was, I basically took over a position as I was joining the firm, and it was just assigned to me. The hedge fund already took a couple percent position in it, and basically threw me on as coverage. And this was my first thing, so I was extremely excited, and I think the emotion of being excited about it kind of drove me to say, okay, as long as I work really hard and I try to come up with all these innovative insights, I can make substantiate a really interesting thesis here. But I think I was crossing the line of trying to be a bit circular. So not letting the work substantiate the investment, but because it was assigned to me, I kind of felt like I didn't really have the ability to push back or disagree with the actual investment. And I think one thing I really learned was, and very quickly, is that you have to really speak up for yourself. And some funds actually would like you. They'll tell you'll feel more welcomed when you kind of just listen to what they have to say and do what they say or whatever. At the end of the day, if that doesn't make them money, you're still going to be in a worse spot. So you really have to do what makes money and make people money. And that's really the secret there. So I would say in this particular situation, I did a lot of really complex analysis, but I think I was pushing it to the point of missing a bigger picture point on this particular investment. And I think that led it, we lost a little bit of money on it. If I pushed harder, who's to say whether they would have really listened to the new guy to like get out of this investment that was assigned to me anyway. Something I've thought about long after the fact. But, I think the right thing to do would have been for me to really just come up aggressively and say like, look, this is not a good idea. We should get out of it. And that's hard to do for somebody who's starting their first investment job on Wall Street.
Well, I can understand that. I mean, you're throwing in, you want it to work, right? But then, like you said, in a bad result, regardless, you're going to be taking the heat. So you might as well think critically, really put forth your judgment, let them know, and okay, whatever happens, but at least you'll have done your best. I think that's
right.
A fair point. And then I had another one final question. Of course, maybe there's some final ones from the group. But you were saying about evaluating opportunity and seeing if a firm seems to fit and if they're really care to support you, right? To find the opportunities themselves doesn't sound easy. And then you say, well, find the one that's fit for you, which sounds even harder. How do you go about finding opportunity, or how do you, leverage your network, or so you're in this position where you get to find this great opportunity?
Yeah, it's hard. I'd say, it's a combination of a bunch of factors. I would say some of it is, kind of knowing a reputation of certain firms to do certain things. and some of that is just doing your own research, either within your network, going to different Wall Street events, getting to know the types of people at these events.
Yeah.
I'd say interviews are a great way to kind of start to assess, but interviews also have some flaws too, because, I think when anybody's trying to get somebody to, when they're trying to hire somebody, it's not only that the candidate's being interviewed, but you're also, the firm is also being interviewed, right? So, candidate might put on their best behavior and therefore assume, that they're probably less perfect than what they present themselves as, but same with the firm. So it's hard to say what the best way is, but, in reality, you're probably going to have to do a combination of everything above. And some of it is going to be trial and error. Try to make your best judgments, look out for any red flags where people, talk about certain values in conversation and they really don't match up with yours. You should give them some weight beyond just, I need a job and I need money, or I want to make a lot of money. And you need to have those as a factor in your search.
Mm-hmm. Okay. Well, I think that makes a lot of sense. I think this has all been very illuminating. I don't know if I'm ready for a career in finance, but I think a lot of our students are more prepared about really what they could be looking at if that's the path they choose. Any other final thoughts from you, Brian?
I am really optimistic about the future of everybody on this call. I'm sure there's lots of opportunities for everybody here, and I think as long as you are passionate about Wall Street and about your ability to hunger for knowledge and learn and really question, the status quo, I think there's a lot of things to be done, and you can really have a career full of a lot of success. So those are my parting words. And if anybody has any questions, feel free to reach out. I'm happy to talk further, and John can connect you.
Yeah, absolutely. Well, thank you so much, Brian. Thank you so much to our audience. And everybody have a great night. Have a great day. Thank you.
Good evening. Good day, guys.
Okay. Thank you. Okay. Bye-bye.